Many retirees don't realize that they can use an annuity to delay required minimum distributions for 10 years or more. Now, we know RMDs can be quite costly from a tax perspective, but does using an annuity to delay these forced distributions make sense? That's what we're going to explore in today's video. Now, for those that aren't familiar with required minimum distributions or RMDs, these are forced distributions from your tax-deferred accounts once you reach a certain age. Currently, RMDs begin starting at age 73 or 75, depending on your birth year. Most people will be subject to RMDs from their traditional IRA or traditional 401ks, but they can affect all of the account types that I have listed on the left-hand side of the screen. Now, why do RMDs exist in the first place? Well, effectively, the government gives you a benefit when you contribute to tax-deferred accounts. Any contributions to these accounts lowers your taxable income in the given year the contribution is made, and you are able to defer those taxes until when you withdraw from these accounts. Without any constraints, you could effectively defer taxes indefinitely if you don't readily need to use the money within these accounts. This would be a bad deal for the government. To prevent this, the government forces you to withdraw from these accounts at a certain point so they can get their tax dollars back. Well, this can be quite costly to you as a retiree. On the right-hand side of the screen, I have the forced RMD withdrawal rate at various ages. The older you are, the bigger percentage you must withdraw. Now, imagine being a 75-year-old and you are forced to withdraw and be taxed on $10,000, $50,000, or even $100,000 that you don't need. As a general rule of tax planning, we will do best if we have control and optionality over how we take our income year to year, and RMDs prevent this in a great way. So the idea of being able to avoid or delay RMDs is quite intriguing. Now, there are a lot of methods to avoiding RMDs altogether. One of the key ones we talk about on this channel is through things like Roth conversions. Roths are not subject to RMDs, for instance. But there's another method that is growing in popularity and leading to a lot of questions from retirees. This method is a specific type of annuity called a QLAC and was permitted by law in 2014. Here's how the annuity works big picture. Say you are currently 65 years old and have some big tax-deferred balances. Maybe these balances are too big that you don't want to Roth convert, or maybe you just don't like the idea of a Roth conversion. A QLAC allows you to take a portion of your tax-deferred accounts, say $200,000 in this example, and you would take these funds and buy a deferred income annuity. Deferred just means this income isn't starting immediately, but rather at some point in the future. Now, your normal starting RMD age would be 75. Using a QLAC, you are able to defer income within this annuity as late as age 85. During this time, none of the money in this annuity will be subject to RMDs. Then at age 85, your guaranteed income for life begins. For someone that doesn't readily need to use $200,000 in the immediate future, a QLAC can look quite attractive on the surface. After all, you're able to delay forced distributions for at least 10 years. But is there a catch? That's what I want to explore. But first, let's familiarize you a bit more with what exactly a QLAC is. First, QLAC stands for Qualified Longevity Annuity Contract. And these are only designed as income annuities, meaning the income needs to turn on at some point in the future. The maximum that you can invest in a QLAC as of 2025 is $210,000, but this amount will adjust to inflation in the future. These cannot be variable or index annuities. Now, what does this exactly mean? Well, variable and index annuities have two components. They have a guaranteed income stream, and then they have the cash value of the annuity in the background. These can be attractive to some investors because the cash value of the annuity will grow according to the underlying investment in that given contract. This can create a situation where theoretically a retiree can draw guaranteed income from a contract for 20 years and still have some cash value left in that contract if the growth has been sizable. This means there is a potential estate planning interest in these type of contracts. A QLAC works a little bit differently. A QLAC can either be insured based on your life or joint life if you are married. Joint life means the contract pays based on whoever lives longest. These do not have a cash value feature, and effectively when you pass away, the money you put into the contract is gone. Not a big deal if you live into your 90s, as you likely got quite a bit of money from that contract, but if you purchase this annuity at 65 and die at 70, well, you can lose all of the money that you put into the contract with no benefit to you or your heirs. QLACs allow you to delay payouts as late as age 85, but know that you do have some control over this. You could have payouts begin at age 80 or 75, for instance. This being said, the point of this contract is to delay RMDs, so many retirees try to use the maximum delay. Then finally, know there are currently only a few insurance companies that offer QLACs. To qualify as a QLAC, you need to buy a specific QLAC contract. A simple deferred income annuity will not suffice. Now, there's one feature that is offered with both QLACs and SPIAs. A SPIA is simply an income annuity that has income payouts begin more or less immediately. SPIAs like QLACs do not have the cash value feature that variable and index annuities have, but they do have the opportunity for a feature called a refund at death feature. Here's how this works. Let's say you purchase a SPIA or QLAC at age 65 and you unfortunately pass away at age 70. In the case of a QLAC, you receive no income yet. In the case of a SPIA, you've received income but not enough to equal your initial investment. Well, a refund at death feature ensures that at least your estate will receive at least what you initially invested into that annuity. So with the example on the screen, the 65-year-old bought a SPIA and received $35,925 over 5 years. They pass away, and because they purchased an annuity with this refund feature, their estate will receive $64,075 to be made quote-unquote whole on the initial investment. No, this is not a free feature. In this situation, buy a SPIA without this feature, and you would receive about $500 more per year compared to buying one with this feature. Generally speaking, on a statistical basis, there's no advantage to choosing the refund option or not. Actuaries are pretty good at pricing these features in such a way where there isn't a free lunch to be had, at least on an average basis. Now, from here, what I want to do is compare using a QLAC to a normal immediate income annuity and see if that QLAC is even a good bet for those looking at guaranteed income for life. Then I'm going to compare a QLAC to simply keeping the money invested in your IRA and suffering through the RMDs to see whether this is even a valid RMD avoidance strategy after taking into account all of the relevant variables. So first, let's compare QLACs and immediate annuities and see what we can learn. In this example, we're going to be looking at a 69-year-old female whose starting RMD age is 73. Now, both a QLAC and immediate annuity retain the tax deferral feature, so there's no immediate tax consequence to buying either of these annuities. They effectively stay within your IRAs, and you are just subject to tax when you receive the income payouts. In each category, I've also chosen the second best contracts to compare, as I think they are more illustrative of the general market. Sometimes the best contracts can be an outlier and only available for a very short amount of time. I also do not have any refund at death features with either of these options. If she were to purchase an immediate annuity, this retiree would start receiving $16,100 per year immediately. This amount is not inflation adjusted, but would continue for the remainder of her life. If she were to purchase a QLAC, she would delay income payments until age 85. But at that point, the income payout would be much larger due to that deferral, and she would start by receiving almost $70,000 per year. So ultimately, what is more valuable for this retiree? Yes, with an immediate annuity, she's receiving income for an extra 16 years, but is receiving a smaller amount of income. If we just look at a raw dollar basis, because the delayed payout is so much larger, it would only take a bit more than 4 years after the QLAC started for both of these income annuities to have generated the same total income. But here's the problem with that comparison. A dollar today is more valuable than a dollar tomorrow. We can invest a dollar today and have more by tomorrow, let alone years from now. So to compare both of these payouts on a more accurate basis, we have to use something called a discount rate. A discount rate is effectively a safe return that we can earn on money today. In this example, I'm using a discount rate of 4%. So any income that we receive in the future is discounted by this discount rate to give us a present value calculation. Let me blow up this graph so it's a little bit easier to read. The biggest risk and concern with a QLAC is that you need to live a pretty long time to even have a chance of breaking even compared to a normal immediate income annuity. Based on this present value calculation, this retiree would need to live past age 92. At this point, the QLAC starts winning out handily, and the gap between these two investments starts widening quite quickly, which makes sense. It's the difference of $70,000 per year versus only $16,000. But the issue is that break even is quite far in the future. There's another problem that's worth underscoring. With no refund at death feature, this retiree won't receive any value from the QLAC until age 85. If this retiree passed away at age 84, they would simply lose the $200,000 altogether. And that's not even accurately assessing the total loss this retiree suffered. What they really lost is the potential for what that $200,000 could have turned into if invested elsewhere. Then finally, tax problems aren't necessarily solved in my view. We live in a progressive tax system where the more income you have, the higher tax rate you will generally pay. Given this, it's likely that receiving $16,100 each year will be less tax costly than receiving nearly $70,000 per year for a shorter period of time. To draw a similar analogy, it's almost always more tax beneficial to do ongoing smaller Roth conversions than it is to Roth convert everything all at once, because you are able to spread out that tax liability across lower tax rates. Given all of this analysis, a QLAC is looking like maybe not the greatest bet. But let's keep going further. It's worth mentioning again that based on the features of a QLAC, for a QLAC to make any sense, you have to be willing to bet heavily on your longevity. If we look at this 69-year-old female and look to the Social Security actuarial tables, we see her base life expectancy would be to age 87 and a half. As an additional data point, a 69-year-old female has about a 1 in 3 chance of reaching age 90, which likely means the chance of reaching age 92 is in the 25 to 30% range. Let's do another comparison, where we look not at purchasing an income annuity at all. Instead, we just suffer through the RMDs. Here we are comparing a $200,000 IRA and taxable account to a $200,000 QLAC. We're going to assume the IRA and eventual taxable account earns 6%. Now, I want to be very clear that this is not an apples-to-apples comparison. To earn 6% on your money, you are taking risk in investing, whereas with an annuity, the underlying risk-return profile is guaranteed. There also isn't an investment that currently offers a 6% per year return on a straight-line basis. More likely, that 6% will be volatile. And as you would theoretically withdraw from that IRA, there's something called volatility drag that can drag down returns. To make up for this issue within this comparison, I use what I think is a fairly conservative growth rate at 6%. Since 1950, a 60-40 portfolio has averaged over 9%. So 6% is quite attainable, at least on a historical basis. Then behind the scenes of this analysis, I've accounted for the tax drag of RMDs on the IRA. For each given age, I have the RMD coming out. I have the retiree paying tax on that RMD, and then we're reinvesting that money into a taxable account. That taxable account is then growing in value. To add further conservatism to this analysis, I have the RMD that will be coming out from the IRA taxed at 25% and the QLAC income only taxed at 20%. So I'm giving an extra advantage to the QLAC here. Despite this, we actually don't see the QLAC ever catch up in after-tax value, at least to age 100. Now there is a break-even point after age 100, but that's a moot point for almost everyone watching this video. Given these variables, it's hard for me to see an obvious case for a QLAC based on current annuity pricing. Now, annuity pricing does change, and so do other variables in this analysis. I would never say there's no case for a QLAC, but I certainly struggle to see a strong case right now compared to alternative. But let's condense everything we've gone over into some clear takeaways. First, this presentation is not a knock against income annuities. I think income annuities can certainly serve a place in some retirement plans. Yes, you are generally accepting a lower return when using income annuities, but that's because you trade upside for guarantees. And those guarantees can offer some legitimate peace of mind advantages. Second, for a QLAC to beat an immediate annuity, or really even be a good investment period, the retiree buying this annuity needs to live a pretty long life, generally well into their 90s with the assumptions that we used. Then this might be the biggest one. Many retirees are attracted to QLACs because of the RMD delaying feature. However, our goal is not to avoid or delay RMDs. If our goal was just RMD avoidance, a viable strategy that meets that goal would be to just lose all of the money that you have within your IRA before you reach RMD age. By definition, you avoid RMDs in that case, but that's obviously a crazy solution. Our goal is to invest and tax plan in a way where we end up with the most after-tax wealth. For some retirees, this might mean complete RMD avoidance. For others, this might mean just having to eat big RMDs. Avoiding RMDs alone is not the objective. Then finally, be careful around purchasing annuities as there are a lot of dishonest practices. I see a lot of fear-mongering around RMDs where QLACs are often offered up as one of the only viable solutions. This is not the case. A QLAC is simply a tool in a toolbox full of other tools. The best RMD avoidance strategy is one that is holistic and takes into account other, often more preferred strategies like Roth conversions. If you like this video and want to learn more about RMDs and how you can avoid them, click this video right here where we talk about 15 things that you didn't know about required minimum distributions. Click here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.